In this week's video, we'll answer the question, how bad do the weekly stock charts look? We'll take a look at weekly momentum, the VIX, market breadth, slopes, risk on versus risk off, small caps, and long versus short. In honor of Super Bowl week, we'll be running the CCM no-huddle offense and moving through the charts quickly. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Since we always want to maintain maximum flexibility and observe the markets with an unbiased mind, we'll kick off the video this week with the chart of the VIX. It's weekly. Here, the VIX hit resistance. The S&P 500 gained. Resistance on the VIX. Stocks did well. Resistance in the same general area. Stocks did well. General area, stocks went up. We're in that same area again, which tells us regardless of how the charts look now, it's extremely important that we keep an open mind because things can change. If you follow us on Twitter, you've seen this chart before. This is new highs, new lows here where my cursor is on the S&P 500. This speaks to market breadth. All things being equal, when the line is rising, it's better for stocks. You can see when the line gets some red here, we get weakness in the S&P 500. Red, red, accompanied with weakness. Red, red, weakness. We do have some red again. It's the first time we've had red for some time. What does it mean? It just increases the probability of bad things happening. This is a weekly chart of the NASDAQ used in the CCM market model. Those of you that watch our videos on a regular basis, you know that when momentum drops out of overbought territory here, the probability of bad things happening in the NASDAQ increases. If you drop out, probability of bad things happening increases. As of the close on Friday, January 31st, we are out of overbought territory for the first time in several months, which increases the probability, and we think in probabilities, of bad things happening. If you follow along on Twitter, you know we've mentioned that we're seeing some things that we didn't see for the entire calendar year of 2013. This is one example. This is the same chart we just looked at, but in this case, it's the S&P 500 weekly, and this is momentum. The same concepts apply. Momentum is currently lower now at the blue dotted line than it was at any point in 2013. In fact, the last time Williams percent R on a weekly basis closed this low was here, and you can see bad things continued to happen on a weekly chart. Present day, momentum got that weak after coming out of overbought territory. Overbought, weak, similar. Bad things continued to happen in the S&P 500. Present day is here. Came out of overbought territory. Out of overbought. Came to the same level we are today, a level that was not reached in 2013. After this point, the probability of bad things happening was higher. As long as this chart continues to look like this, it will check negative boxes in the CCM market model. Regular viewers know that we use this chart to stay with the trend in 2013. We're looking at stocks versus bonds. If you're new to the fold, we'll explain some basic concepts here and then show them on charts that follow because the concepts will apply there as well. This is stocks versus bonds. When the ratio is rising, the demand for stocks is greater than the demand for bonds. This is what risk on looks like. This is what risk off looks like. The moving averages help us discern between volatility to ignore, and volatility to respect. A full-bore bullish look is price, or the ratio in black, above the blue and the red moving averages, and the slopes of both are up and blue is above red. A full-bore bearish look where the probability of bad things happening, this is the S&P 500 here, for reference purposes only, increases. You can see in 2013, we never had a weekly close with a bearish cross on the moving averages, telling us this was volatility to ignore. Volatility to ignore, volatility to ignore for the most part. Blue never closed below red. Blue did not close below red. Now we have something different. For 2 weeks in a row, we have a full-bore bearish look. This looks similar to this, and the present day doesn't look anything like this, where gains in the ratio and gains in stock followed. How long will this last? We have no idea, but as long as it looks like this, it will check bearish boxes in the CCM market model. When it morphs back into a look like this, it will tell us to start migrating back towards a risk-on stance. We're taking the same concepts that we explained in the last chart and now reporting them to these weekly charts that are used in one of the submodels in the CCM market model, the correlation model. This is the weekly S&P 500. It currently has that full-bore bearish look. This is, would I rather be long or would I rather be short? Full-bore bearish look, answering the question, I'd rather be short from a probabilistic perspective. Stocks versus the aggregate bond fund, full-bore bearish look, I'd rather be in bonds than stocks. One of the strengths of the CCM market model is the wide variety of indicators and indices that it reviews on a real-time basis. Same concepts, small caps, have now morphed into a full-bore bearish look. Risk on, the S&P 500 relative to risk off, the VIX, full-bore bearish look. Stocks relative to conservative long-term treasuries, full-bore bearish look for stocks. And you can see TLT, which we added to our portfolios last week, did well this week. TLT outperformed the stock market by 1.16%. As long as these charts and ratios maintain a look like this, we'll continue to migrate away from risk. When they improve and look more like this point here, we will begin to migrate back towards risk based upon the observable evidence. No opinions, no forecasting. If you're not a client, you can't watch the movements in your accounts. For the record, a week ago, Friday, on January 24th, we discussed buying TLT on Thursday the 23rd and Friday the 24th, as well as incrementally cutting stocks. Both of those moves recommended by the model helped us in the past week as TLT outperformed the stock market by over 1%. Clients and Twitter followers know that we began scaling into the market after the October 9 low, and we tweeted this as observable evidence as one of the reasons why the odds were improving. From this point here to this point up here somewhere, the Dow, after the 50-day turned up here, the blue line, gained over 1,000 points. Now we have the mirror image of that. The 50-day is starting to roll over in a bearish manner and prices below it. Momentum is weak and still in oversold territory. As long as this looks like this and prices below it, we'll be concerned. When will it move back? We don't know. We don't need to know. When it does, we'll be happy to migrate back in this direction. We just looked at the daily chart of the Dow. Same concepts apply to the daily chart of the S&P 500. Price is below a now negative sloping 50-day moving average. Until it changes, it's checking bearish boxes. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. When we're running a strategy based on observable evidence, it's important to remember that the charts say what they say until they don't say it anymore. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.